RioCan announced an agreement to sell its stakes in 4 residential rental properties. The transaction will result in gross proceeds of $197.3 million. For more on this, let's go to Jonathan Gitlin. He's the president and CEO of RioCan. Jonathan, thanks for joining us today.
Thanks so much for having me, Marilla. Good to be here.
Plan is to sell 50% interest in 4 properties. Why have you decided to do that?
We've built up a great portfolio of residential rental properties in our RioCan Living portfolio. We did this with a view to create value for our unit holders. We wanted to figure out the best way to make that value materialize, and we thought that disposition of those assets in today's current environment is the best path forward. And we have some very, we've been able to surface a lot of value in the transactions that we brought to the table. So we feel very good about the transactions, but we also feel very good about what we can do with the proceeds in this kind of environment.
Let's talk about the environment, because we know the housing market has softened a lot. So is the rental market specifically. Did you feel that sort of led you to where you are today? And was this something you had planned to do a while ago, or did this come up more recently?
No, this is a broader strategy. We've been saying for a long time that we had this wonderful business, we still do, where we've taken a lot of the well-located shopping centers in our portfolio and intensified them for higher and better uses. And that was logically mixed-use, multi-res rental apartment buildings. And over time, we wanted to build scale. We wanted to build scale so that we'd have a lot of options to surface value from that portfolio. Some of the options we had was doing a public spinco, doing some sort of a private vehicle, or selling the assets as we're currently doing. And that's a long-term strategy. It was not really linked to any weakening in the environment. And truthfully, for these types of assets, which are brand new, transit-oriented, major market, high-growth assets, even if there is a bit of weakening in the rental market, these types of assets are highly sought after. They're highly productive assets. So we're not surprised that there's been a lot of uptake in terms of their marketability.
Do you plan to do more? Do you plan on putting up more residential properties for sale?
Well, these 4 assets were only a small part of our overall RioCan Living portfolio. We have another, close to $1 billion of inventory that we are either completing or have completed. And so there will be more to follow. What I did say is that over the next 12 to 24 months, our plan is to surface more of the value from this great portfolio. And then RioCan itself, we have still about 20 million productive square feet of density in our portfolio, meaning really well-located assets that could use higher and better uses. And that won't go away. And so we do have, I think, a lot of runway to surface that value as well as we go forward, whether it is developing them with partners or selling that density outright. It's definitely a part of our story going forward, and I think it will be part of our growth going forward as well.
You mentioned the current climate. You said it didn't really affect too much what has been going on with sale here, but I'm wondering if it has moved at all your plans forward, either purchasing or building, anything like that.
The rental or the housing environment, I still do believe there is a housing crisis in Canada. I think there's been a significant amount of new inventory, particularly in places like Toronto, that has hit the market and will allow a bit of, I would say, volatility in the rental market because all these new condo units have hit the market. That, of course, leads to more units for rent. But that will end. I think that influx of inventory will end. And to me, that will ultimately lead to a significant increase in need for these types of units. And if you look at the history of rental in places like Toronto, Montreal, Vancouver, over the course of the last 30 years, there are certain dips in the market at certain times. But if you look at the overall trajectory, it's been a pretty steady state of growth and I would say stability. And these assets, I think, will be no exception to that. So I think there will always be marketable assets. I think that the current environment, it might be a slightly challenged environment, but we don't think that is a long-standing trend.
Let's talk about retail platforms as well, because you were affected by the closure of the Bay. Initially, you were expressed unhappiness, I guess, about that. What is your take on it? First of all, how it's changing the retail landscape with the Bay sort of leaving and shutting down?
I think the retail landscape is a much broader picture than the Bay. The Bay is a lot of negative optics around an environment that's otherwise extremely positive. If you look at open air shopping centers, the type that RioCan owns in the major markets throughout Canada, the strength is absolutely evident. Our occupancy rates for retail is close to 99%. Our leasing spreads, which is the amount of growth we're able to get in each new or renewed lease, are in the high double digits, or the high teens, I should say. And these are remarkable stats, better than we've ever done before, which points to the fact that open air necessity-based retail is very much in demand. And the good news is for us that there's been no new product built in that regard over the last decade, and we really don't see a catalyst for more being built. So it's a pretty protected market. So I think retail in general is very strong. Of course, you're going to get the odd exception or high-profile story like Hudsons Bay, but Hudsons Bay is a very small element of a much broader and much stronger ecosystem of retail. So again, I think focusing on as I would ask you to focus on the majority of our portfolio, there's a lot of good things going on. Hudsons Bay, I would say, is the anomaly, not the rule.
So if my count is correct, you have 13 Bay locations under your company. I'm just wondering what you think of the purchase of 28 locations by Ruby Liu, who has some plans for them. We're not sure what those are. But what's your take on her buying up some of these leases?
I think it's great. I think it shows that retail is in demand, and the Hudsons Bay, for better or for worse, did have some strong locations. And I think someone like Ms. Liu, who I don't have any direct dealings with, but she sees the strength in the Canadian retail market, and she sees the value in creating something new here, even using some older components to do it. And to me, that echoes the truth around retail. We are under retail in Canada. There is demand for different types of retail, and I think to see something like that just echoes those sentiments in the broader marketplace. So I think it's positive. I'm not surprised by it. And I think there'll be more of it, quite frankly.
I'm just wondering, and you mentioned sort of it is a more difficult time for retail in Canada, and a lot of American enterprises here have shut down and closed. Part of it was the pandemic, of course, but even post-pandemic, and now we're seeing a Canadian brand lost as well. Just what's your general take? Because some feel like it's not going to come back, or it's definitely not going to come back in the footprint that it used to.
Mm-hmm. So I actually give it a different point of view. I think it's a positive tone for retail in Canada. You're probably referring to retailers like Target who've come here and then left. But right now, what I see, and I have seen it for a little while, is a lot of very strong retailers, both domestic and global. Retailers like Costco and like Walmart, who are expanding in Canada. In fact, we're doing a few new deals with Costco. They're doing remarkably well, and they recognize the strength in the Canadian consumer, and they really want to grow in Canada. And then you've got our domestic retailers like Loblaws and Dollarama and all of our grocery suppliers, for that matter, who are actually looking to expand, who recognize that there's a lack of good supply of retail. And so when it does become available, as we're evidencing in our statistics, they're scooping it up as quickly as they can. These are sophisticated retailers. They recognize the need for more retail in the strong Canadian cities. And that's why we're seeing a lot of demand for our space. So I actually see the future of Canadian retail being very strong, and I don't see a catalyst for that dissipating in the future.
Got it. Jonathan Gitlin, I do have to leave the conversation with you there, sir. Thanks for your time. Jonathan is the president and CEO of RioCan.